Well, welcome everybody. Thank you for spending some time with us today. I'm John Hughes. I'm the Senior Vice President and National Leader for MNP's Private Enterprise Group. This is one of a series of seminars that we'll have in our Business Owner Series. We'll give you some contact links later as well, so you can hopefully join us on a future date on the topics that are important to you. This one in particular has got a lot of interest, and we've got almost 2,000 people registered, which is fantastic. And so we've got a cross-country team working with us here. Appreciate all our folks on the technical side. And then I'll get a chance to introduce a couple of my partners in just a few minutes. Next slide, please, Stephanie. So just a bit of a caveat now. We will speak about some things that are, will continue to be relevant for families and private businesses. Some of the tax information that we'll talk about later too, obviously, is subject to change. So a bit of a caveat there that, whatever you do here today, certainly take those ideas and we're happy to share them with you. But, in all cases, there's probably some more information needed. And for many of you who are good clients of MNP, then check in with your partner and your team in doing that. A bit of background. I'm not sure if everybody knows. You can flip the next slide, Stephanie. Thank you. Just some background. Back to the framework. The MNP is the largest professional service firm dedicated to the mid-market. We have over 400,000 clients in Canada. 90% of them are private companies, like many of yours. And of that, 80% of them are families. And so our guidance and our hope today is we're going to provide you some insights that will, one, make the businesses better, but also make the families stronger. And as we've come through COVID, I don't have to tell this group, change has been a constant. And so hopefully today we'll share some of the insights that we've seen. This first slide was something we put back. It's always good to use content more than once, but it stood the test of time. This was a framework when COVID first hit and some of the key areas that businesses and families were dealing with at that time. I don't want to go into a lot of detail here. You'll certainly get these slides afterwards and we can talk about it, but certainly top of mind at that time. Corporate finance, looking at balance sheets, looking at income statements with COVID, the incentives the government had issued to private companies really helped in that regard. So we were getting a lot of questions from clients around how to deal with their banks and how to sustain themselves as we've come out of this. So I think we're all optimistic that by this summer, and knock on wood, we do exit this and then get back to business. Wealth planning is another big one. My partner Jim's going to talk a little bit about that later, but it's certainly been a question on the minds of many business families as to what happens now, what happens with wealth. And I think we're going to get into some questions around interest rates and things like that. So we'll look forward to that discussion. My partner Eddie, he'll introduce himself, is a tax specialist and business advisor to many private companies and families. And so he'll share some of his insights on what to expect, particularly with the new government now and some of the changes that are happening in the tax law. Succession planning is another area all three of us actually focus on, and it will be a separate topic one day, but it'd be hard not to talk about coming out of COVID and succession as many families evaluate now. How do we stay successful coming out of COVID? Or are we at a point now where we want to either hand it off to the kids or sell, and we'll get into that discussion. Next slide, please, Stephanie. The framework we use, and Jim will talk about this as well, is really the three-circle model. This is not a new model. It was developed in the US many years ago, but it's interesting, if you haven't seen it, to look at the dynamics of family businesses. They're so unique. There's the ownership piece, who are the shareholders, the business, who is management, and then obviously the family, it's the strongest unit when you look at this model. And where the intersects happen, that's in our experience as a mid-market professional services firm, is where the conflicts arise. And so a lot of the work that we do and the insights we can hopefully help you out with today is to consider those in your own business. This is something great to share with your family and your management teams, is to look at, where are the issues here. And that could be where a family member might be a shareholder and one might not be a shareholder, those types of situations. And I think we'll get into some of that discussion today as we talk about strategies. So I'm going to hand it off to my partner, Jim Ray, sits out in Calgary. Jim, over to you.
Thank you, John. Good morning and good afternoon, depending on where you are in Canada today. My name is Jim Ray. I'm a partner in the Calgary Private Enterprise Practice. And having worked with enterprising families for over 25 years, and as they've grown and aged over the years, as have I've noticed that they need more than traditional accounting and tax advice. As the owners and their business matured, I began to hear more questions along the lines of, how much do I need to fund my retirement? How do we transfer our business to our kids? When should we share details of our wealth with our kids? And as I developed the skills to better advise on these issues, I felt rewarded seeing the positive impact of our work in this area on our business owner clients and their children. I found the best process for clients to gain clarity and confidence in their future is to help them develop a personal financial plan. Next slide, please. There are 6 components to a comprehensive financial plan: financial management, insurance and risk management, investment planning, retirement planning, tax planning, and estate planning. Before we work on the deep technical areas of a financial plan, we need to understand what your goals and objectives are. What are you trying to achieve? Your primary objective may be to live out your life comfortably with enough money to travel, entertain your family and friends, and enjoy your hobbies. Other objectives may include building an education fund for your children and grandchildren, leaving a large sum to charity, and providing a down payment for your children's first homes. You need to ask yourself, what is wealth for? You're either going to spend it or give it away. If you don't spend it in your lifetime, you're going to give it away on death to your children, friends, charity, whoever you've bequested it to, or perhaps the government. And you don't want to give them too much. And if you want to give some away before you die, your financial plan will tell you how much you can give without affecting the achievement of your goals. So on the first point, financial management, we formulate a picture of where you are now, your financial position or net worth, which tabulates the values of your assets and liabilities. Then you'll summarize your monthly earnings and expenses to produce your cash flow statement. Are you spending more than you're earning? Unless you're already in retirement, this doesn't bode well for achieving your goals. Do you know what you spent last month? Is it sustainable? From this, we can help you prepare a budget. And I know everybody hates preparing budgets. I'll bet most business owners and tenants remember a time when they wondered whether they would have enough cash to pay their employees. This may have been during the startup phase, or it may have been as recent as the current pandemic. Just as we learned that we need to forecast our cash flows to run a successful business, we need to forecast our personal cash flows to successfully reach our personal goals. We also need to understand how we are managing our risks. How are you managing your exposure to unexpected financial loss due to death, health issues, property damage, business interruption, and other risks? A good financial planner will compare your risk exposure to your insurance coverage and identify gaps, prioritizing risk management needs. Purchasing insurance is one of the ways to manage your risks. Depending on your current circumstances, you may need life insurance, disability insurance to protect your loved ones should your earning capacity be temporarily or permanently interrupted. If most of your wealth is in illiquid assets, such as shares of your company or real estate, you may want life insurance to provide funds to pay the taxes on these so they don't have to be sold at fire sale prices. Risks may also be managed through contingency planning, making sure those entrusted to look after your affairs have explicit instructions on what to do and where to find important documents. Then we need to look at your investments. Is the return you're experiencing sufficient to provide income you need once you stop working? Once you know the rate of return required to achieve your goals, you can design your investment portfolio to include assets that align with your risk tolerance, past experience, your attitudes, your objectives, and your time horizon. Some of the questions that arise in retirement planning are, will your current savings and investment strategy provide for the lifestyle that you desire in retirement? Should you contribute to your savings to your RRSP, your spouse's RRSP, or your TFSA? Should you convert your RRSP to a RIF or an annuity? Should you collect OAS and CPP earlier or later? And the big one, when can you retire or at least slow down? All of these decisions can be helped with this financial planning process. In tax planning, we look at your current and future tax obligations and strategies employed to minimize or defer taxation on personal and business income. Can the business be structured so as to minimize tax on sale or transfer? Should a family trust be used? Are your registered and non-registered portfolios allocated for maximum tax efficiency? How do you make sure your wealth transfers to your children with the minimum amount of tax? And in the last stage, the sixth component, estate planning, how will the expenses on death be funded? Taxes, funeral expenses, that sort of thing. Are your wills up to date? Do you have powers of attorney in place? Do your wills clearly state your wishes? We've found in our review of some wills that the wills actually don't, the outcomes don't match what your intentions are. So those are important to look at. So let's take a poll now. Who has a current financial plan? Next slide, please. So we can see that the answers are pretty close to what studies have found nationally. Almost 40% of people don't have a financial plan. 31% have one that's prepared by themselves, which is really good. We've got a lot of experienced people in attendance here. So that's probably a lot higher than the normal Canadian citizen. And 30% have financial plans prepared by a financial planner, which is excellent.
Yeah, if I can, we always get a question around financial planning. And for many folks, and we can see by the numbers, not having put one together, the question is, where do I start? What's the easiest way to kind of kick that exercise off?
Well, there are different, I would recommend a certified financial planner. So we know certified financial planners are often at banks, life insurance companies, and here at MNP. Certified financial planners are accredited by the FP Canada, and so they have to follow policies and regulations and professional standards, and they also should be unbiased and objective, and that's the kind of advice you're looking for. Not someone who is just trying to sell you a product, but wants to help you and give you the best answers in an unbiased fashion.
Right, thanks.
So who needs a financial plan? Like a good business plan, a good personal financial plan increases the likelihood of achieving your goals, improves the confidence in your decision-making, and it also is flexible. It's a document that continues to be looked at and revised as your assumptions change, as things happen in your life circumstances like a death or a marriage or a divorce. You can change assumptions as to your retirement date. I think a lot of people have changed their expectations for retirement date during this COVID pandemic. Rates of return may change, number of children. You can compare alternative scenarios. Should we sell the cottage and live in the city? Shall we sell the city home and live in the cottage? What are the implications on our financial plan? So a good financial plan can show the results for any of those.
You know, this is one area, as Jim gets into the slides in financial planning, that we found is a wonderful opportunity. We've just come through the holidays, so I'm sure we had not as big family gatherings as we would have wanted at that time, but certainly would have had a discussion if you're a family business or own a business, is, you know, what's next and what are we thinking about going forward. So it is a wonderful time, and we're finding now with succession is such a big opportunity. It's to involve that next generation if you haven't already, and we'll talk a little bit more about that. Doing a financial plan, as Jim outlined, because there's so many pieces to it, and getting that done right gives you all permission to talk about what's going on within the family. I think we're going to talk about it later. You know, some if it's parents or founders of a company aren't always comfortable sharing all of that, but our experience is we can educate that next generation, you know, at the pace that you think is right. But it's we always see that as a wonderful opportunity outside the business to get the family together and start to think about, you know, what is the next stage.
Thanks, John. Let's go to the next slide. And because your time is valuable, and I know you want to spend enough time on our tax update and questions, I'll summarize quickly some of the aspects of family governance. Families that run businesses or that have built significant wealth have increased in complexity. Members of the family that work in the business will understand aspects of the business differently than those that don't work in the business, as we saw in the three-circle model. This can lead to frustration and animosity. What family governance seeks to do is instill cohesiveness and cooperation through sharing of information and responsibilities, resulting in a happier family that works together to fulfill the family mission. The most important factors in maintaining a cohesive family while managing a complex business or investments are culture, communication, policies, and education. Culture is all about what's the family's history, how is the business started, and why. The more the subsequent generations understand the family culture and its origins, the more likely they are to feel an affiliation with others in the family. In communication, how do family members outside the business understand what's going on inside the business? Policies. What kind of distribution policies are there? Who gets dividends? Who gets salaries? Are there gifts involved? Everybody wants to understand what those mean. Education is extremely important for the subsequent generations. It's a big task to manage family wealth and to manage the family business. So they need financial education. You may want them to get experience outside the firm to bring in some fresh ideas. And you may want to start them young, delegating responsibilities at a young age. They maybe give them the responsibility of organizing the next family reunion, chairing a family meeting, managing a mini portfolio of investments. All of these foster engagement, which maintains commitment to the family's vision. I'll pass it over to Eddie now, who will discuss tax implications related to family wealth and business transfers.
Thanks, Jim. Maybe we'll get to the next slide. But before we started this, I mean, Jim's comment about, you know, family planning and financial planning for the family in terms of preserving wealth, you know, tax comes to mind without a doubt. That, you know, the biggest erosion of one's wealth is taxation. You know, that taxation that's occurred during the period of time that you've earned that income, that taxation that applies on transfer of one's wealth. And without proper planning, it really becomes problematic, because oftentimes we face the issue where people come to us with a transaction, a succession, a family business, maybe being sold to the next generation, et cetera. And taxation then comes to mind. So starting off, before we get into some of the matters on taxation, I have a quick polling question for everybody here. So maybe we can ask the polling question here. Do you actually have a strategy around your tax plan in dealing with your business transition? Yes or no? And it's interesting here that we're actually talking about not just a strategy, but also one that deals with taxation. Have you addressed the taxation matters? No, no surprise, as I would say. And I think, John, Jim, and I would tell you that, this is often the response that we get from many individuals, that it's one of the last things they think about. They're focused on their business. They're focused on the success of their business. They're focused on growing their business. They're worried about, obviously, a lot of the issues that we've all faced as owners and entrepreneurs over the last little bit, COVID, their employees, et cetera, et cetera. The last thing that most people think about is taxation. And when we think about taxation, it's only when there's a incident or there's a pivotal moment, a event that actually causes us to pause for a moment to think about it. A sale, a transition of the business to the next generation, or as Jim mentioned, estate planning, where we're talking about preserving as much wealth as possible before we transfer it on. So what are some of the highlights I want to bring in today's conversation? Number one is, the throne speech. We often as practitioners glean a lot of what is being said in the throne speech as basically the direction the government is going. And what many of us probably heard was the government is strongly committed, to ensuring that, number one, all our businesses, all our employees, all our people of Canada will survive through this pandemic, and they will do whatever it takes to make sure they provide us the financial ability to survive the pandemic. So great news, the government is behind us. They're going to provide programs that support us in all doing this. It does beg the question, how are they going to pay for all this? How eventually will we pay for the deficits that have been created? And if anybody's been reading some of the papers as of late about inflation, one of the key instigators of inflation has been the aggressive government spending that we've seen over the last 18 months or so, and that's driving inflation up. And it is a definite concern. And it could be now the output being the increase in interest rates and the like. So the throne speech definitely has been an insight, providing us insight, the fact that what is the government going to do around taxation? And I must say that a lot of the platforms that have been put out as of late by any of the parties primarily has had an element of taxation. If we look at the Liberal platform in this past election, they had a platform where they wanted to introduce a 15% surtax for those ultra high net worth individuals where they weren't paying their fair share, quote unquote. We've heard the wealth tax. We've heard a lot of rumors around the NDP wanting to introduce a wealth tax, and we've heard things about the wealth luxury tax, like we've seen in the sales tax with vehicles and boats over $100,000, and all these legislations that were proposed as ways of raising revenue for the government and dealing with the raising of tax revenues to help pay for these costs, like the deficit we're facing. Capital gains rate. This has been a instrumental and I think problematic area that we've been talking about for the last little bit with a lot of business owners. Those that are looking to enter their business, those are looking to do some planning. What are we dealing with this capital gain inclusion rate? Simply stated, today we have a 50% inclusion rate. Good news. However, we're all very nervous. We were nervous in the fall when Chrystia Freeland was going to introduce her economic statement of whether she was going to increase that inclusion rate from the current 50% to as high as it used to be, 3/4. Nothing happened. Will they revisit that in March? Should you plan for that potential increase in the capital gain exemption rate? Possibly you should be thinking about that, especially if you're thinking about business transition, possibly selling assets, possibly liquidating or moving your personal financial portfolio in a way to reposition it, for a better longer-term growth objective. And again, as I said from the beginning, taxation tends to be one of the elements that erodes one's personal wealth and business issues and business wealth issues. So where is the capital gain inclusion rate going to go? Good question. I wish I only had a crystal ball to be able to predict where it's going to go. However, a lot of commentators have said if the government is going to raise some tax revenue, this is a simple one to change to increase that tax revenue. And so as business owners, entrepreneurs, we should be prudent in being able to assess what are the potential outcomes. Are we selling assets? Should we take a defensive move to protect ourselves, protect that wealth if we are transitioning our business and trying to capitalize on the current 50% capital gain inclusion rate? Where are corporate taxes going? I hope they stay the same. We awfully seen, around the world right now, we saw the UK increase their corporate tax rate. We saw the US, the Biden administration, put out news about how they want to increase their rate. They're currently at 21%, cheaper than Canada. We're at 26, and we saw the corporate rate, they're proposing to go from 21 to 28, possibly as high as 29. We've seen the UK increase their corporate tax rate 5%. Their announcement was basically, we need to pay for the COVID deficit created. We're increasing our corporate tax rates. Will Canada follow suit? Will they be part of the G7 countries that will elevate their corporate tax rate in the years to come? Possibly. We'll see. It is a concern. I like to think they will not, given the fact that where we are at the corporate tax rate, we're still competitive. But we can all know that if our competitors, our other countries around the world, decide to increase their corporate tax rate, we could see pressure on our corporate tax rate going up as well. And that may be something you may want to plan for, once again, in terms of your business succession, estate planning, family wealth planning. What could happen if there's an increase in taxation? It's an erosion of one's personal wealth. So how do you hedge against that? We've always heard the rumbling that maybe they'll go back and revisit the HST. Will they go back and look at the HST? And we've heard lots of studies, a lot of commentators, the Fraser Institute, a lot of studies have gone into suggesting that if they would only increase the HST by 1%, you raise about $8 billion. And wouldn't that be a better revenue source? Clearly an issue for those that, are expense consumer oriented in the sense that, will it impact families, the grocery bills, et cetera. And gasoline prices, we've seen fuel, HST will only add that problem. For most businesses, it should be a neutral element, but for the economy as a whole, it could be a very good, strong revenue source that we can look at. Will the government move that way? Probably highly unlikely. They know it's a bit of a political football at this point, and they probably won't want to touch the HST rate. But then again, we never know. Will it be a temporary change in order to help pay for the deficit that we're currently in? Again, where does this mean from a financial planning perspective? It could be, and again, one's erosion of personal wealth. We have been on many a committee, M&P particularly has been many times asked, what are other avenues that we should be looking at, from economies in terms of helping entrepreneurs at the same time raising tax revenue. It's always at the top of their mind that they raise tax revenue. And, we do know, and we have seen the digital sales tax has been introduced as a measure of raising that tax revenue. We also do know that some of the strategies out there today will not last. There are some planning opportunities, and we've seen literature, for example, on estate planning. Estate freezes are being subject to review. We've heard noise about principal residents. They may want to tax principal residents. Again, these are aspects that would need to go back and assess in one's personal portfolio to see, does it have an impact if you did tax principal residency, and what would that mean? Personally, I think Jim and John and I would tell you that they're probably not looking to tax one's principal residence, but the real focus is on those flippers, those that own a property only for a short period of time, less than a year or maybe a year, and are constantly transacting, selling, reselling those properties. And that's the abuse that the government is looking to tax, not necessarily those that have a long time homestead in their portfolio. But taxation is one's erosion. You need a strategy. I think when we started off this discussion, we saw that most people don't. Most people don't think about tax until some incident, some event, some pivotal moment in time comes about that people have to think about it. Starting early allows you to preserve your wealth. Starting early on the tax planning allows you to maximize your wealth transfer to the next generation. Starting early maybe means implementing an estate freeze, so as you cap the value of one's estate today and pass on most of the growth to the next generation. These are still viable tax tools that are available to entrepreneurs that are looking to preserve wealth and pass that on to the next generation. John, I know some questions have come in. Maybe we could address them at this time.
Yeah, I'm going to try and curate. There's a few of them that are related. So thank you, everybody who sent those in. Anita and Warren, thank you. Very similar. So Anita's question, sorry, let me just put my, Yeah, Anita's question, I'll do that one first, and then I'll lead into Warren's because they are related. So Anita's question is, when is the best time to pass on real estate to children to minimize tax? And Warren's a related question. There's more here. The supposed one-time capital gain exemption is for personal family businesses, but can't be used on the sale of real estate. So what are some of the strategies that we can employ to make that transition as tax efficient as possible?
Yeah, it's a good question, right? So, we it's a complicated question because really what's not clear from the questions is what type of real estate we're talking about. And I think John, Jim, and I, we've always had to deal with cottages, right? The family cottage, right? We want to keep the family cottage, and in our generation, we want to pass it on from one generation to the next. And I could see from Anita's question, maybe it's the cottage that we're referring to. Often what we see families setting up family trusts. And depending on the age of mom and dad, some of those trusts that you set up the real estate in isn't taxable currently until the passing of mom and dad. But the asset itself, the real estate, can be held in that family trust until sometime in the future, and then ensure the automatic transfer of that property in a nice, efficient, and thoughtful way. People have often used a trust vehicle for, like, say, cottages and the things like that to ensure that they have the right, the enjoyment throughout their lifetime, with the residual passing of that asset on their death to their kids, and therefore even postpone the tax at that time. The capital gains exemption is a good one. We saw that amendment happen many years ago, that real estate was removed as an eligible asset from the capital gains exemption. And today, the capital gains exemption, over $900,000 for 2022, is really reserved for either shares of a small business corporation or shares of a family farm corporation or fishing corporation. So it's very restrictive in terms of what is an eligible asset or an eligible for the capital gains exemption. So unfortunately, when it comes to real estate, one does need to look at what kind of real estate it is and whether you can implement some of these estate freeze techniques, whether we should transfer it to a family wealth corporation where you could cap the value, and then the real estate then passes on to the next generation. It has its own implications. So we may solve one issue about passing the wealth on, may introduce other elements, complexity, filings, et cetera, that need to be addressed. Every circumstance is different. And so we often consult with the people that design a plan that's really unique to their situation.
Eddie, a bit related, and I'll just add it on because we'll pull them all together and deal with the lifetime capital gain exemption. Richard asks, is the lifetime capital gain exemption multiplier via the family trust likely to continue as a viable tax strategy for the sale of shares to a third party?
Yeah, I think the answer to that is simply yes. I mean, if there's one thing that's uniquely Canadian and uniquely beneficial for all Canadian owners, is the multiplication of the capital gains exemption through the family trust. I think I would say to you that there was enough discussion, and all of us had participated in way back in July of 2017. It sounds like a long time ago when these little rules were introduced, and our friend Morneau, which is nowhere to be found these days, when he introduced those rules, I think this was a safe haven. That capital gains exemption is a safe haven, and it's one that's not going to be touched. If it was going to be remended or repealed, it would have been done in 2017. And I think that, they've had their chance, and I don't think it's going anywhere. So I think this is here to stay. Now, I would caution, it's got to be done correctly. A lot of times we do see circumstances going back to where we started from. You got to plan. If this is the intention to multiply your capital gain exemption using the family trust, you got to make sure the company qualifies, because not all shares qualify, and you could easily go offside, and you could be in for a surprise. So I would say to you, planning was critical if this is the intended strategy.
Great, thanks, Eddie. Jim, one for you. And we have, at M&P, one of our largest segments is the ag business. It's where our business started 60 years ago and continues to be our largest market. So Jim, in terms of family assets, and Eddie, you may chime in on the tax on this as well, but Elaine asks, what tools do you see to shift the wealth from the family farm asset base to the personal side, either cashing out or whatever that mechanism is? Many farm families have great assets, but they are not using financial planners to make sure that they have a solid income stream after 65, i.e. retirement, or when they decide to retire from the personal wealth bubble. What tools can help improve that personal income stream?
Well, that is a good question, John. And unfortunately, I don't deal with our ag clients, so I don't really have much on that. Eddie, you run into that?
Maybe on the tax side, Eddie, just talking about that transition, because I know we've done some work with some ag families on it.
Yeah, you know what? It always starts off with a discussion of what is to be done, right? In terms of like we have to have a plan. I mean, there are favorable tax rules definitely on the transition of farm businesses, farm or fishing corporations, or farming operations, fishing operations. There are favorable tax rules. There's one thing that's for sure, is there is the ability to transition the business, the farm operation, the fishing business in a very tax efficient way can be done. And the deferral of that tax can definitely be done. You just have to be thoughtful about it. And one thing that is supportive of all that is the income tax provisions that exist today. I would say, when you talk about the tools, is starting off with your advisors, your key group of advisors. We talk about, obviously the tax and financial people have to be involved. Your insurance people have to be involved, because you got to understand what that transition is going to look like. And if it does, and we talk about a role for insurance, and, Jim, you highlighted this, there is a role for insurance and all this. So I think getting your group of advisors together in any type of transition of any business, let alone ag or anything else, is critical and have to be assessed. Do all the tax rules work the way people anticipate them to work, or are there surprises?
Yeah, follow on, Eddie, too. Similar question from Rob. When you talk about farm transitions, so it looks like there's an example here, transitioning to 3 adult children. Should we use a trust, a shared title? What are some of the insights around what structures might be used?
Yeah, so I'll start off by saying, the trust is a very valuable vehicle. But the trust, the trust is really often used in place for purposes of control, where mom and dad still want an element of control over the affairs of the property. Perhaps, they have children that aren't married yet and they don't know who they will be married to. Maybe they're concerned about who may get, maybe it's not all 3 children that will want the farm. Maybe 1 or more of the children want to do something else. The trust is a great vehicle to postpone, but yet control the asset in the interim of that period of time, that allows you to assess what is going to be the outcome. So I think the trust is often a very valuable vehicle when we deal with family transitions, estate planning, because it gives mom and dad the time to really gain more insight as to who the asset is going to go to, control the asset during the interim period of time, because they don't want to lose control during their lifetime. And the trust is a very valuable vehicle for that.
Great. Let's switch gears a little bit. Eddie, one of our good clients, Brian in Montreal, had a question around, and this is a big one, so I know we're not going to get to all the details today, but designing a compensation plan, and we talked a little bit about it, for obviously his executive team, but also the family members. So what are some of the insights you'd share in terms of building one of those plans?
Yeah, I'll start off and then Jim could jump in as well. Employee ownership, is a very valuable tool. I think anybody who's been reading the Toronto Star over the last little bit, Frank Stronach has put out an article out there about, what will make an economy successful. His recommendation is employee ownership. His recommendation is, if you can introduce your key employees and they have a vested interest in your business, it's not only good for them, it's good for your business, it's good for the economy. That's, from Frank Stronach's perspective. Now, what's a key element to that? There are many different types of plans. There are plans ranging from, employee stock ownership program, phantom plans. There are different plans to introduce them. So I think one of the key requirements is, number one, starting off by getting an understanding of what behavior, what objective are you trying to achieve? For some people, for example, and I'll use, large construction companies here in Toronto have used an employee share ownership program for multiple purposes. One, to kind of linking that employee to the company, getting a level of commitment to the business success. So it's a bit of a golden handcuff that they're now vested into the success of the business. And so for they're tied to it through an employee ownership program. Other people just use it just for an ability to do profit sharing. Have a phantom plan where they're able to share in the profits, but not necessarily in the equity ownership. So again, some other programs are designed only equity. There is no income distribution during one's ownership, but there is a payoff in the event of one's exit. So one of the key things that we often start off by understanding these employee ownership programs is what behavior are we trying to achieve? And what is it we're trying to achieve overall? Are they really trying to build a company for exit? So we want an accretive program, or do we want a program that pays income out? Do we want a program that links people to the business and rewards them? So there are many objectives. What's the behavior outcome we want? And the programs are designed around that.
Great, thanks, Eddie. And as Jim mentioned earlier on, part of financial planning, one of the critical points is insurance. And I'm again curating the questions here. We've got a number of folks, Eddie, that are asking about insurance. And I think it would be helpful, if you don't mind, to kind of give the folks an overview of what kind of insurance is out there. Obviously, it's picking the right one, but what are some of the types of insurance? And then also, there are a couple of questions around using the insurance in a holdco and those type of things. I know this is going to be a longer answer because it's quite involved, but maybe just the highlights.
Jim, you want to take a crack at that one?
Sure, I'll speak to just the general types of insurance out there that people would look to. In life insurance, you can really divide it into two. There's term insurance and permanent insurance. So term insurance, usually you get for a certain period, 5, 10, maybe it's renewable every 10 years or something. And this is to cover you in your earning years, just to protect your family. Permanent insurance, as long as you're paying the premiums, can last right up until end of life, and can also have savings components to it. So it can be part of a savings program that's tax deferred, and it also provides life insurance for life. Other insurance that's important to protect your earnings is disability insurance. Those can be obtained both through some group plans, but you may want an individual plan. So if you're self-employed or if you move employment, it stays with you. Some newer insurance like critical illness insurance is becoming popular, and probably Eddie can speak to some of the tax implications of that. And long-term care insurance is also increasing as people look at the costs of taking care of themselves when they're not able to. They would like some insurance that will cover their home care costs. And that can be, those costs can be pretty significant when you get on into your 80s and 90s and beyond. Eddie?
Thanks, Jim. Insurance is an interesting topic. And I think all of us would agree here that insurance has a place in everybody's plan. The real question really comes is, what is that, and how will you do it? And what I mean by that is, for some people that have, I'll say businesses that have illiquid assets, real estate, and we know we're transitioning the family business to the next generation, and the company owns a significant amount of real estate that's not easily saleable. Insurance plays a key role, right, to help manage the liquidity the estate will need on the transfer of that business. The mom and dad have built up a significant nest egg in real estate, not easily saleable, or better yet, you don't want to have a fire sale, but the estate needs liquidity in order to pay the taxes. Insurance plays a critical role. We've seen this in shareholders, arm's length shareholders, Mrs. A, Mrs. B own the shares. They have a shareholders agreement. In the event, one of them passes away, we need a way of providing, the estate of the deceased shareholder liquidity. Insurance plays a role there as well. What type of policy is best for those type of arrangements. It's really dependent on the facts and circumstance. In shareholder buyouts, we often find term insurance is a very cost-effective way to hedge against the potential liquidity required. For estate planning, as Jim alluded to, we often find people gravitate to universal life or whole life type policies because you're holding it for one's lifetime to deal with one's estate liquidity issues. Part of the use of insurance really depends on what's it going to be used for. And there's a lot of people that I think spend time to understand what do they want to provide their inheritance, their kids. What inheritance does that look like? If some businesses are highly liquid, they're in cash, they may not be fussed about getting insurance because the beneficiaries have access to liquidity to pay for the tax. And therefore they don't necessarily need that insurance cost. I would say other people use insurance as an alternative investment vehicle, and it has to be given some serious consideration. Funds within an insurance policy, like a whole life policy, your universal life policy, don't attract taxation. And the current returns in some insurance policies are very attractive, especially when you factor in the fact they're not taxable. So some people use insurance as a mechanism to augment their family wealth. By being able to earn income within an insurance policy on a tax deferred basis, and that will provide for their kids one day in the future, but at the same time can combine that with a leverage concept where you can leverage against the policy in some fashion to pay for current living expenses. So there are unique aspects of using insurance for one's personal financial planning. It's a topic on its own, John. We could go all day.
I know we could do a whole we could do a week of sessions on insurance, but thanks for the quick overview. Hopefully that was helpful to our friend. Another one here, a couple of them regarding Bill C-208. Was it passed? How does it help succession? And maybe for the benefit of those who may not have heard about it, just a quick overview. What is Bill C-208? And to the point, why is that such a help for succession?
Jim, you want to start, or I'll take this one on? Okay, so Bill 2 is C-208. Okay, so listen, I'll do the history lesson first. The C-208 is a very interesting circumstance that arose, right? So briefly stated, if mom and dad want to sell their shares to their kids, son and daughter, before C-208 showed up, mom and dad would sell their shares, say use their capital gain exemption, $900,000 each to son and daughter. And then son and daughter would have to get their own money to pay for that $900,000. They effectively could not take that $900,000 from their operating business or holding company to pay mom and dad off. It was treated as a dividend, in effect. You were basically taxed as a dividend. It really was an inhibitor, and this was actually came out loud and clear in 2017 when a lot of small businesses were protesting against the fact that you could sell your business easily to a third party than it was to sell your business to your own family, and because the tax rules were punitive. The tax rules were and I say were because it's pre C-208, were punitive to sell your business to your family members. Versus trying to sell your business to a third party. Why? Again, because your family members were not able to access the cash or the proceeds in order to pay mom and dad off. This raised a lot of concern amongst a lot of people about the basically the unfairness within the tax provisions to allow a favoritism to selling to a third party versus family members. Bill C-08 was introduced in order to level the playing field. So C-08 was introduced as a private member's bill that basically now permits son and daughter to effectively extract that $900,000 that mom and dad are going to use to shelter their capital gain on the sale of their shares from the company to pay mom and dad their money, not taxed as a dividend. And so therefore the monies that son and daughter could use could come from the company, be provided to mom and dad on the purchase of their shares, and not be adversely affected by the tax rules. And C-208 was introduced to allow that to happen. So today, that is a possibility, which is a huge advantage for mom and dad. That said, though, there are some restrictions. It's not available to everybody. The companies are really, that provision is really designed for small business companies. And it has to be done in a way such that you are transferring the ownership of the business to son and daughter. Now, will this legislation C208 survive? Initially, when C208 came out, it was, quite frankly, it came to surprise to all of us practitioners that it came out in the current form, because we think it's flawed in the sense that it's far broader in its application than what was originally intended. The government acknowledged that. The government, Department of Finance, Chrystia Freeland came out early in June, in fact, told all us practitioners to hold off, that this legislation is designed incorrectly and that they would amend C208 to be consistent with what they wanted it to do. We were all expecting as practitioners that this C208 would come out in November, that there would be an amendment that would be introduced in November that basically would kind of restrict or basically reduce the applicability of C208. That didn't happen. So much to our surprise, in November, Chrystia Freeland did not announce any changes whatsoever to C208. So it currently exists in its current form that allows mom and dad to sell their shares to son and daughter. They could each extract $900,000 without any tax being paid. Huge benefit if you could fit all the specific logistics of the legislation. Will it survive? Again, we speculate as practitioners, but we think that come the budget, the finally they'll announce the changes that they are intended to make. We understand that the government kind of backed off in November given the Omicron crisis, and they thought, Canadians had to be stabilized, the economy had to be stabilized. They didn't want to introduce any tax changes. So it's a wait and see, but the proposal was that law was supposed to change. It hasn't. If you can use it, do it before the government changes.
Very thorough analysis, Eddie. The only thing I'd add is that the seemingly temporary nature of C208 has given a lot of people thought about doing their succession planning now instead of waiting. So we've seen a lot of extra work in succession planning because of that. And hopefully it'll last a little bit longer because a lot of people still want to make use of it. I see one here that's been upvoted a number of times, John, from Zahir. Asking about financial planning is offered by a lot of different organizations, insurance agents, bankers, accountants, wealth managers, even lawyers. So depending on what products are used as solutions and tools, these products compensate the planners via commissions, be it insurance commissions or spreads on investments, bank fees, etc. Please share your insight into what the fair and reasonable fees should be for proper and full financial planning, including things like wills. So yes, financial planning has been performed a lot of through the years by these firms that are selling product, and they offer the financial planning for free on the expectation that they hope to drive some more business. And there's nothing wrong with that, but there is a big trend to fee-for-service financial planning. And that would be you pay for the financial plan, and there's really no subtle or built-in commissions or anything that are tagged with it. I would say that fee-for-service financial planning would tend to be more unbiased, and that's the way we charge for financial planning services. I can't really comment on wills. Those are really a purview of lawyers, and charging a fee for that based on the time seems reasonable. Everybody's, as our financial plans, every plan is very unique to an individual, and every will is very unique to an individual. So some take a lot more time than others.
Great, thanks, Jim. And I'm going to pause there. I'm mindful of time and respect everybody's time for joining us today. We've had a tremendous number of questions. I don't think we got to them all, and sorry about that. But if I can ask, you can certainly follow up with your NNP representative, and they will surely be able to give some insights. If not, we are going to send out a link later with the slides. Our team will send that out, Stephanie, and a link to the other business owner series that we've got going on. If there's anything else you'd like to talk about, just flip us a note back and we'll make sure we get you in front of the right person. So with that, I want to thank my two partners. As always, huge insights and great conversation today. This is an important topic now, as I mentioned, coming out of COVID, and particularly now with succession being on the minds of many, many family companies. To our technical team, Stephanie, Samantha, Aaron, Adam, thank you for taking care of that. And again, thanks to our friends for joining us today. Continued success in your personal and business lives. All the best now. Bye-bye.